Good afternoon and welcome to KPMG's LinkedIn Live. Today's discussion features Peter Torrente, KPMG's National Sector Leader for Banking and Capital Markets, and our guest, Tom Michaud, President and CEO of KBW. KBW, an investment bank focused on the financial services sector, is a subsidiary of Stifel Financial. KBW's highly regarded bank research team has the broadest coverage of the banking industry on Wall Street, covering not only the nation's largest banks, but most of the leading regional banks as well. And now for our presentation.
Hey, Tom, welcome. Hope your 2022 is off to a good start. Certainly a lot going on, and I really want to get to your outlook for the industry for 2022. But maybe before we do that, love to get your perspective on earnings season, which is about to kick off here later this week on Friday.
Well, terrific. Well, Peter, great to be with you and Happy New Year to you and all the viewers. I think that this is going to be a very important quarter for the banking industry and for financial services because we're starting to see how industry dynamics are going to play out post-COVID and post the COVID recession. So we, back in September, had upgraded the entire banking sector to a buy from an equity perspective. And there were three primary reasons why we did that. One is we felt that loan growth was going to accelerate from where it had been. Number two is we felt that interest rates were bound to start moving higher. And then number three is we think that the industry was going to have better opportunity to deploy a record amount of cash that's on the balance sheet. Pre-COVID, about 2.5% of a bank's balance sheet was in cash. Today, it's around 10%. So we felt that those were three powerful drivers that were going to be able to get the industry out of a flat revenue environment. Because during the tail end of last year, the industry was having no natural organic loan growth. And the industry was still struggling with zero or near zero interest rates. So we felt like an inflection point was in front of us. Now, when you look at what's happened, the H8 data just came out for the fourth quarter, which explains what's happening or organic loan growth. And it looks like loan growth is running at a 15% annualized growth rate in the industry. We've been modeling 7% as our baseline case. So what we see in the fourth quarter makes us feel pretty good about what loan growth could be. And that was one of the key stories of the third quarter. As far as interest rates go, I think all the viewers are aware of the shifting sands that have been happening with regards to monetary policy. There's talk now that we could see three or four rate increases this year. In the middle part of last year, we thought the most likely scenario would be one in December of 2022, and then maybe one more in the first half of 2023. Now we could be seeing three, we think, this year. And actually, we've been modeling in three more for this year and then one in the first quarter of next year. And so we expect there to be some Fed rate activity in terms of increasing rates. And these increasing rates, as you know, are really just removing emergency measures from zero interest rates. So with regards to the quarter, we think the focus is going to be on the revenue picture for the industry, which is there's going to be a lot of talk about the industry going from no revenue growth more towards more or some revenue growth. And I'm talking about the general traditional spread lender. The story with the biggest banks in investment banking is very different. The biggest universal banks, as you know, are much more exposed to non-interest revenue sources. And that'll be a story of what's happening in the overall macro markets. Just with regards to that, our view is M&A is likely to continue to remain strong. We're looking for equity trading to continue to be up. We're looking for fixed income trading to start to normalize and start heading back towards 2019 levels. So that'll be a little bit of a headwind. We think the fourth quarter will be very good for investment banking in general when you add it all up. But headed into future periods, we think you could see it wane a little. So we think it's going to be a good quarter. We recently raised estimates because of this better view for loan growth and better view for higher rates. And so we're now about 4% higher than the rest of Wall Street for a typical spread lender SMID cap, that's a small and mid cap bank. And then I should real quickly too, just talk about a couple of other things, which is we expect credit quality to continue to be excellent, capital to continue to be excellent, funding to continue to be excellent. So that's our view for the fourth quarter.
It's a good recap of what you're expecting for the quarter, Tom. And I think if you think about continuing to navigate through the virus and then touching on some of the items you touched on, the potential rise in interest rates, looking at the inflationary environment and just the general economic outlook, how do you see 2022 shaping up for the industry?
Well, I think operationally and on a core basis, it's going to be a good year. And I think some of the unnatural things that were happening during the COVID period are going to start to fall away. So, for example, we just went through a very volatile period for loan loss provisioning. Rightfully so, in 2020, as the industry started to implement CECL and new accounting provisions, we saw an enormous amount of provisioning. And then in 2021, we saw the negative provisioning, unwinding that provisioning as the losses didn't happen. So we think 2023, will certainly be a normal year without a lot of that, we'll call it noise. And we think 2022 is going to be a year without a lot of that noise. By not having noise means we're not going to have negative loan loss provisions in 2022, which means you're going to see reported earnings being down materially, but they're going to be down because last year, 2021, was aided by negative loan loss provisions. So I don't think that the market is going to focus as much on that. I think the market cares most about the organic story that's happening in the industry. And really, like I said earlier, where there was no operating leverage last year or was negative operating leverage because revenues just weren't growing and there was some expense pressure, I think this year is going to be a story of unfolding positive operating leverage for a traditional bank. You'll be able to see a little bit more loan growth, a little bit more spread income, and that those will be positive to change the glide path for revenues, which is something we haven't seen in a while. And that's one reason why we've been so optimistic on the stocks.
Tom, you mentioned stocks. How do you see the valuation for the industry versus the broader market unfolding? It's still at somewhat of a discount. How do you see that playing out?
There are two ways to measure valuation. The first is, how does valuation look relative to history, just on a standard PE, price to book type basis? If you look at that, what you'll see is that the industry is still, well, for the biggest banks, they're pretty much in line where they've historically been. For the mid-sized banks, they're a little bit below where they've been. Where it gets to be really interesting when you look at the relative price to the overall market, because financial stocks for a long period of time underperformed the market. So at the beginning of the year, the typical regional bank that we followed was trading at 65% of the market multiple. But the last time the Fed went through a rate increasing period was from December of 15 through 18. And during that time, the average relative PE multiple for a bank was closer to 91%. So we see there's a really good chance for there being relative outperformance in the stocks. It's already been happening this year. Last week, for example, I think the bank stocks outperformed by over 10%, the overall market. So in particular, it's these mid-sized regional spread lender banks that we think are best positioned for that. We think the largest universal banks had their moment last year. We don't think that they're necessarily as well positioned as at this moment. So this is the reason why we've had a bullish call on these stocks. And then I should also talk a little bit about the technicals. I find that stocks tend to do well when estimates keep going up, and that's the period that we now think we're in. And then also we're watching the passive investor flows in the ETFs, and we're seeing a lot of inflows into financials. And so we think that that's something that's creating a positive environment for these stocks.
You talk about the largest banks and then the regionals as well. Maybe we kind of turn to fintech for a minute, and whether it's big tech or fintech, love to get your outlook on that segment of the market as they continue to compete with the traditional banks.
Fintech is going to get a lot of talk this year. I'm really intrigued about the idea of what are the history books going to, aside from the human cost, which has been too much, but what are the history books going to say about what happened during the COVID period? And when it comes to financial services, I believe a primary aspect is going to be how the adoption of technology and digital engagement and fintech offerings just exploded during that period and probably accelerated what was already going to happen by 5 to 10 years. So it's all happening right now. Interestingly, I think it's created a situation, what I call regulatory arbitrage, which is innovation is well ahead of financial regulation. And I think we're going to spend the next 2 to 3 years in our country having regulation catch up with some of this innovation. And in that regard, I'm talking about stablecoin. I'm talking about cryptocurrencies. I'm talking about development of blockchain payment technologies outside of the traditional networks. And I'm talking about fintechs that are coming into the financial services industry that are using banks as a service to execute their plans. There's a lot going on. The change is exciting and threatening at the same time, I believe. But I think we're going to be talking a lot about it. And I know my firm is doing a lot of work to try to stay out in front of it. But I think it's something that investors are going to be paying a lot of attention to as we go forward. Something that's happening, though, too, that I think that's just an interesting signal of to the degree is I'm not sure if Peter, you followed or others have followed the fact that MSCI and S&P have a proposal in the marketplace to change the categorization of some of the companies in the S&P 500. For example, they're going to be moving processing companies like FIS and Fiserv and Jack Henry, as well as payment companies like Visa and MasterCard out of the tech sector and into the financials category. What that has the impact of doing, by the way, is it has the impact of taking financials from the number 4 weighting up to the number 2 weighting, changes the weighting from about 10.5% to 13.5% of the market. And it also knocks out, and when you look at who the top 4 financials are going to be pro forma, it'll knock out some very big companies like Morgan Stanley and Wells Fargo from being in the top 4 in terms of size in financial services. They'll now include MasterCard and Visa. So I think it says something about this confluence and this collision that's happening.
Yeah, that's really interesting. And do you think there'll be any change in the way those, what were kind of historically, is the way you describe it, identified as tech as they move into banking? Do you think it'll change the way they're valued based on multiples or?
I'm not so sure how much it will change the Visa and the MasterCards, but I think it has a really good chance of changing the banks and other financials that adopt that. I think the lines between all these verticals about what's a tech company, what's a financial company are going to become blurred. I think the walls between verticals are starting to come down a little bit, especially within financial services. I think pretty much every company in every category needs to have technology as their partner. Not only do I think is it going to have a difference in terms of how companies engage their customers, I think it's going to make a difference on how they operate their firms. Some of these digital-only banks are going to market with the idea that when they normalize their balance sheets and size, that they're going to operate with efficiency ratios at 30%. That's in an industry where many of the players are at 45 to 55. So there's going to be a lot of competitive dynamics that change because of these companies. And I think investors are out looking for companies that are on the forward end of that curve and that they're willing to evolve their business models for what should happen and will probably likely happen in the future.
Yeah, a lot to follow over the coming quarters on that. You mentioned regulation a little bit in your comments there. Obviously, some open positions to be filled in Washington. love to get your thoughts on the outlook from a regulatory standpoint. Some say 2022 is the year of regulation.
Unfortunately, the world we live in at the moment, Peter, is one where the regulatory pendulum seems to swing a lot. So clearly, I think we're in a position where you could see regulation get more assertive. And with the divisions that are in Congress, it's very likely that Congress won't be passing laws to change the regulatory framework of financial services. It's a little bit more likely that the executive branch might use their power of regulation to try to implement change. And so I think that's the dynamic that could be at work for the next couple of years. You're seeing it somewhat in the executive order from the president in terms of consolidation. And as you know, the banking industry has been undergoing consolidation since the mid 80s. And it's an important factor for financials as financials try to gather more scale to be able to compete with these technology companies and these other new competitors, as well as these very big banks. It's important for how all this gets executed and what the policies are. So we think that you're going to probably see a little more assertive regulation going forward. And also, like I said earlier, this regulatory arbitrage between innovation and the current structure, I think, is going to have to close. And my sense is that that's not even a partisan issue. I think that's a bipartisan issue. And I know that a lot of the players, for example, in the crypto space, know it's going to happen, and they even speak to it happening as well. But the pendulum's moving again is the answer. It doesn't seem to really stop in a single position. It seems to go through this swinging motion over the years, and that's certainly what's at work now.
Just thinking about it in terms of the M&A environment, obviously last year we saw many deals get announced, and we've seen over the last month a few more of those being approved with a few more pending. How do you see the next 12 to 24 months from an M&A standpoint, Tom?
I think M&A is going to be active. I think one of the more important aspects of it that I hope plays out the way it's starting to seem as if it's shifting is a lot of the banks that were involved in merger of equals or larger deals relative to their size. Their stocks didn't act well after announcement and during the regulatory review period. We're now seeing some of those deals close, and we're starting to see those stocks act better. And I think that as the market watches these management teams execute their plans, and to the extent they do execute, which is they are creating better, more profitable banks that are better able to serve their customers and grow, I think you might see a little bit more investor support for consolidation. So that was one of the themes. There wasn't a lot of investor support out of the gate on announcements last year, but yet the stocks, now that they've closed the mergers, are outperforming. So I think that's a positive. And these banks, I think, are going to come together because they realize that scale has been working in the industry. The bigger banks tend to be more profitable. And also they seem to have more wherewithal to be able to stand up to the big four. As you know, the big four banks in America control 40% of the deposits, and they're growing faster than the rest of the industry. So the rest of the industry wants to make sure that they're standing up competitors. And that's happening at the same time that technology is competing more with the banking industry. You also have the shadow banking industry that's probably at a record market share. So these competitive dynamics, I believe, are driving a lot of this consolidation as the industry is trying to become more profitable, to be more important to their clients, communities, and shareholders. So I think you're going to see more of it. And then another thing I'll say, at least in my firm, we've probably never sold as many non-banks to banks as we've done over the last 12 and 24 months. So I think that's a trend. You're going to see more crossover within financial services as the companies build out their businesses.
Yeah, thanks for that, Tom. Great discussion. Thank you for sharing your industry outlook with us and your insights. Look forward to picking up the discussion again in early April. Thank you.
Terrific. Be safe, be well, and Happy New Year.